bonds and bond valuation, understanding bonds, valuation, and key concepts. Financial market structure refers to the way financial assets like stocks, bonds, and commodities are bought and sold. It's like the marketplace where people and businesses trade these assets. Example in simple terms: imagine you have a big trading hall where people buy and sell different things like toys, clothes, and electronics. In this hall, you also have a special area where people trade financial assets like company stocks or government bonds. This area is the financial market. In this financial market, investors can buy shares of a company, just like buying a piece of the company. If the company does well, the value of those shares may go up, and the investors can sell them to make a profit. Similarly, people can buy and sell other financial assets like government bonds, which are like IOUs issued by the government. When you buy a bond, you're lending money to the government, and they promise to pay you back with interest after a certain time. This trading hall and the different sections inside it represent the financial market structure, where various financial assets are bought and sold based on supply and demand, affecting their prices. In simple terms, bonds valuation involves two main players: companies that offer products and services like ABC Electronics. Fidelity, as an investor, buys some of these new bonds by paying cash to XYZ Corporation. Buybacks Corporation buys its own stocks or bonds. Simple explanation: buybacks occur when a corporation repurchases its own stocks or bonds from the market before they are due for maturity. Process in simple terms: the corporation wants to reduce its debt or return cash to investors, so they bring cash to the dealers' investment banks like Morgan Stanley. The corporation buys back its own stocks or bonds from investors, like Fidelity, at a predetermined price or at a premium. Simple example: suppose Microsoft issued stocks in the past, but now they want to reduce the number of outstanding shares. They decide to buy back some of their own stocks. They contact investors like Fidelity and offer to repurchase their Microsoft stocks at a specific price. If Fidelity agrees, they sell the stocks back to Microsoft and receive cash in return. Secondary market trading dealers trade stocks or bonds with investors. Simple explanation: secondary market trading is when investors buy and sell existing stocks or bonds among themselves or with dealers' investment banks. Process in simple terms: after the stocks or bonds are initially issued in the primary market, investors like Fidelity can buy and sell them with each other or with dealers' investment banks like JP Morgan. Investors can sell stocks or bonds they already own to other investors or dealers, and vice versa. Simple example: Investor A owns shares of a company's stock and wants to sell them to take profits. Investor B believes the stock's price will rise, so they want to buy more. They both engage in a trade, where Investor A sells their shares to Investor B, and Investor B pays cash to Investor A. In summary, primary issuance is when new stocks or bonds are created and sold to investors. Buybacks occur when a corporation buys back its own stocks or bonds, and secondary market trading is when investors buy and sell existing stocks or bonds among themselves or with dealers in the financial market. Bonds and bond valuation. Understanding the basics of bonds. What is a bond? A bond is a type of financial instrument issued by a company or government to borrow money from investors. When you buy a bond, you are essentially lending money to the issuer, and in return, they promise to pay you back the borrowed amount principal along with regular interest payments over a specified period. Bonds are generally considered as a more stable and lower risk investment compared to stocks. Components of a bond: principal, the initial amount of money that the issuer borrows from investors. It is also known as the face value or par value of the bond. Interest. The interest is the additional money the issuer pays to the bondholder for borrowing their money. It is like the rent the issuer pays to use the borrowed funds. Interest is usually paid at fixed intervals, such as semi-annually or annually. Maturity. The maturity date is the point when the bond reaches the end of its term, and the issuer is obligated to pay back the full principal amount to the bondholder. This is the date when the bond matures. Simple example for bonds: let's say company ABC needs $10,000 to fund a new project, but they don't want to take a bank loan. Instead, they issue bonds with a face value of $1,000 each and an annual interest rate of 4%. Investors buy these bonds, lending money to company ABC. Every year, company ABC pays the investors 4% interest on the face value of the bonds they hold. After 10 years, the bonds mature, and company ABC returns the full $1,000 face value to the investors. Stocks. What is a stock? A stock represents ownership in a company. When you buy a stock, you become a partial owner of that company, entitled to a portion of its profits and assets. Unlike bonds, stocks do not involve fixed interest payments, and their value can fluctuate based on the company's performance and market conditions. Components of a stock. Principal. Stocks do not have a fixed principal amount like bonds. When you buy a stock, you're investing in the company, but there is no specific initial amount involved. Dividends. Instead of paying interest like bonds, some companies may distribute a portion of their profits to their shareholders in the form of dividends. These are cash payments that shareholders receive as a reward for owning the company's stock. Maturity. Unlike bonds, stocks do not have a specific maturity date. Stocks represent a long-term ownership in the company, and investors can hold them for as long as they wish. Simple example for stocks. Imagine company XYZ issues stocks to the public. Investors buy shares of company XYZ, becoming partial owners of the company. If company XYZ makes a profit, it may decide to share some of those profits with its shareholders by paying dividends. The value of the stocks can also go up or down based on factors like the company's performance, industry trends, and overall market conditions. Investors can hold on to their shares for as long as they want or sell them in the stock market to other investors. Bonds and stocks. Understanding the differences. A comprehensive overview. Major differences between bonds and stocks. Ownership. Bondholders are lenders to the company and are owed a fixed amount of money, while stockholders are partial owners of the company and have a stake in its success. Returns. Bonds offer fixed interest payments, and the principal is returned at maturity. Stocks offer the potential for dividends and capital appreciation, but there are no fixed returns or maturity date. Risk. Bonds are generally considered safer with lower risk since they have a fixed return and priority in case of company bankruptcy. Stocks carry more risk as their value can fluctuate and they have no fixed return. Influence on the company. Bondholders have no say in the company's decisions, while stockholders can vote on certain corporate matters, depending on the type of stock they own. In summary, bonds are loans to the company with fixed interest and maturity, while stocks represent ownership in the company with the potential for dividends and capital gains. Bonds are generally considered safer, while stocks offer higher returns but come with more risk. For bonds, price. Imagine a bond is like a special toy that you can buy from another friend. The price of the bond in the secondary market is how much money someone is willing to pay for that toy. Sometimes, the price can be higher or lower than the original price of the toy when it was first made. Example, let's say your friend bought a toy for $10, but now they want to sell it to you for $12 because it's a popular toy that others want. Yield. Now, yield is like the extra treat your friend gives you for letting them play with the toy. In the case of a bond, yield is like a small reward the person who buys the bond gets from the company. It's the extra money the company pays you for letting them borrow your money when you buy the bond. Example, if the company borrowed $100 from you and promised to give you an extra $5 every year, that extra $5 is the yield. For stocks, price. A stock is like a share of a big treasure chest that a company keeps. The price of a stock in the secondary market is how much someone is willing to pay for a share of that treasure chest. The price can change a lot, just like how the value of treasures can change depending on how people feel about them. Example, let's say you have a share of a treasure chest from a company. You can sell it to a friend for $50, but later, someone else might be willing to buy it from your friend for $60 because they think the treasure inside is worth more. Yield. Stocks are a bit different from bonds. They don't usually have a fixed extra treat like a bond's interest. Instead, some companies share a little part of their profits with you as a reward for being a shareholder. This reward is called a dividend. Example, if you own a share of the treasure chest and the company makes a lot of profit, they might give you $2 as a dividend for being a good owner of the treasure chest. In summary, in the secondary market, the price of a bond is how much someone is willing to pay for it, and the yield is like an extra treat the person who buys the bond gets from the company. For stocks, the price is how much someone is willing to pay for a share of the company's treasure chest, and the yield is the dividend, which is a little part of the company's profits they share with you as a reward for being a shareholder. Stock trading in auction markets. Imagine stock trading as a big market or a fun fair where people buy and sell shares of companies instead of toys or treats. Shares are like pieces of a company. When you buy a share of a company, it's like owning a small piece of that company. Just like you own your favorite toy, you can own a piece of a company you like. The auction market. The auction market is like a special place where people come to trade these shares. It's called an auction because it's like a game where buyers and sellers try to agree on a fair price for the shares. How the game works. Imagine people standing in this market, like you do at a game stall in the fun fair. Some people say, I want to buy shares of this company, and I'm willing to pay $10 for each share. Others say, I have shares of this company, and I'm willing to sell them for $15 each. Finding a deal. The fun part is when the buyers and sellers try to agree on a good price. They talk to each other, and if someone is willing to buy at $10 and someone else is willing to sell at $15, they need to find a price in between that makes both of them happy. Making the trade. Once they agree on a price, the trade happens. The buyer gives the seller the money they agreed on, and the seller gives the buyer the shares. It's like exchanging money for the company's ownership piece. Simple example. Imagine a company called ABC Toys has 100 shares, and kids are trading them in the auction market. Sarah wants to buy one share and says, I'll pay $8 for one share. John, who already has one share, says, I'm willing to sell my share for $10. They talk and agreed on a price of $9. So Sarah gives $9 to John, and John gives her one share of ABC Toys. Remember, the prices can change a lot during the day, just like toys' prices can go up or down depending on how much people want them. The auction market is like a fun game where people try to find good deals and have fun trading shares of companies they like. There are many places where people trade stocks, and one of these places is the New York Stock Exchange NYC. But there are actually 13 different auction markets for stock trading. Nowadays, most stock trading is done using computers in places like Mahwah, New Jersey. These computer systems help make trading faster and more efficient. Stock markets are like big stores where people buy and sell ownership shares of companies. Imagine it's like going to a store and trading toys with your friends. In the stock market, people trade pieces of companies instead of toys. The stock market works really well, and there are a lot of trades happening every day. It's like a busy marketplace where people are always buying and selling shares. This makes it easy for investors to quickly trade their stocks whenever they want. Bond trading in dealers' markets. When people want to trade bonds, they usually do it in a special place called the dealer's market. This is like a marketplace where investors, people who want to buy or sell bonds, talk directly to dealers, special traders who help with bond transactions. How it works: one-to-one negotiations. In the dealer's market, bond trades happen through one-on-one negotiations between investors and dealers. It's like having a private conversation with a friend or a helper who knows a lot about bonds. Different bonds. A company or government can issue many different types of bonds, each with its own terms and conditions. Some bonds may pay higher interest, some may have longer time periods until they mature, and others may have special features. Matching needs. Investors talk to dealers about the bonds they want to buy or sell. The dealers try to find the best match for each investor's needs, like finding the right toy or treat that you really want. Simple example. Imagine you want to buy a bond because you want to lend money to a company and earn some extra money through interest. You talk to a bond dealer and you say, I have $1,000 and I want to buy a bond that pays 5% interest every year for 5 years. The dealer looks at all the different bonds available in the market and finds one that matches your needs. They say, I have a bond from company XYZ that pays exactly what you want. It's a 5-year bond, and you will get 5% interest each year. You can buy it for $1,000. You agree, and the dealer helps you buy that bond. Now you are a bondholder of company XYZ, and they promise to pay you 5% interest each year until the bond matures after 5 years. In the dealer's market, investors and dealers have these private discussions to find the right bonds that suit their needs. It's like a personalized trading experience for each investor, just like finding a perfect toy or treat that you really like. Risk aversion. Risk aversion means being cautious with your money and preferring safer investments. It's like when you have some money to spend, but you want to make sure it's protected and not wasted on something risky. So you choose investments that are less likely to lose value. Risk is the possibility that the value of an investment, like a stock or a bond, may go down instead of up. It's like when you play a game and there's a chance you might win or lose. In investments, the risk is the chance that you might not get back all the money you put in. Required return. When you invest your money, you expect to get something in return, like earning interest on your savings or getting profits from your investments. The required return is the minimum amount of yield or profit you want to earn from your investment. It's like saying, I want at least this much money in return for putting my money into this investment. Risk premium. The risk premium is like a bonus or reward that you want to get for taking on a little bit of risk with your investment. It's like getting an extra treat for being brave and taking on some uncertainty. Investors require higher returns or profits to make up for taking a higher risk with their money. Now let's talk about how different investments fit into risks versus yields. Treasury bonds. Treasury bonds are like special savings accounts offered by the government. They are considered very safe because the government guarantees to pay back the money it borrows from you, along with interest. So they have low risk. Low yield return. Moderate example. If you buy a $100 Treasury bond, the government promises to give you back the $100 after some time, like 5 years, and they will also pay you extra money, like $5 every year as interest. Corporate bonds. Corporate bonds are like loans that you give to companies. They are a bit riskier than Treasury bonds because companies might not always be as stable as the government. However, many companies are still very reliable and pay back the money they borrowed along with interest. Risk. Moderate yield return. Higher example. If you buy a $100 bond from company ABC, they promise to give you back the $100 after some time, like 10 years, and they will also pay you extra money, like $7 every year as interest. Stocks. Stocks are like becoming a part owner of a company. They can be riskier than bonds because the value of a company can go up and down a lot, depending on how well the company does. But they also offer the potential for higher returns if the company does really well. Risk. High yield return. Highest but not guaranteed example. If you buy a share of company XYZ for $50, the value of that share can go up or down. If the company does well, the share might be worth $60 or more, and you could make a profit. But if the company struggles, the share might be worth less than what you paid. Remember, different investments offer different levels of risk and potential returns. Being risk-averse means being cautious with your choices, and a risk premium means you want extra rewards for taking on more risk. As a smart investor, it's essential to find the right balance between risk and reward that makes you comfortable and happy with your investment choices. Let's break down the time value of money formula and explain how it plays a role in understanding the difference between bonds and stocks in simple terms, using a Texas Instruments BAQ plus financial calculator. Time value of money formula. The time value of money is about understanding that money has different values over time. It's like knowing that $1 today is worth more than $1 in the future because you can use it for something fun or save it to make more money. The formula to calculate the time value of money is price equals PV of future cash flows, discounted at the required return. In simpler terms, it means the price of an investment like a bond or stock depends on the future cash flows you expect to receive, but adjusted for the interest rate you want to earn required return. Example using Texas Instruments BAQ plus financial calculator. Let's say you want to buy a bond that promises to pay you $100 in 2 years. However, since you're lending your money to the bond issuer, you want to earn some extra money in return. Let's say you want a 5% return on your money required return or interest rate. Step 1. Enter the values in the calculator. N equals 2 number of years, I/I equals 5 interest rate, or required return, FV, equals $100 future cash flow. Step 2. Calculate the present value PV. Press the PV button to get the present value, which is the price you should be willing to pay for the bond today. The calculator will give you the answer. PV $90, 70. So according to the time value of money, If you want to buy this bond today and earn a 5% return on your money, you should be willing to pay around $90. 70. Now let's use the same concept for a stock. Let's say you want to buy a share of a company's stock, and you expect the company to make $10 in profit per share in 3 years. Again, you want a 5% return on your money required return. Step 1. Enter the values in the calculator. N equals 3 number of years I/I equals 5 interest rate or required return FV equals $10 future cash flow. Step 2. Calculate the present value PV. Press the PV button to get the present value, which is the price you should be willing to pay for the stock today. The calculator will give you the answer. PV $8. A2 so, according to the time value of money, if you want to buy this stock today and earn a 5% return on your money, you should be willing to pay around $8. 8 in both cases. The time value of money helps us understand how much an investment is worth today, considering the future cash flows we expect and the interest rate we require as a return. The financial calculator makes it easier to calculate these values and helps us make smart investment decisions. Market prices of securities. Imagine you have a special toy that you want to sell to your friends. The price you set for the toy depends on how much your friends think it's worth and how much they are willing to pay. In the financial market, it's a bit like this, where investors decide how much they are willing to pay for a security like a stock or bond based on what they think it's worth and how much profit they want to earn. Cash flows and required return. When investors buy a security, they expect to receive cash flows in the future, like interest on a bond or dividends from a stock. The required return is like the profit percentage they want to earn for investing their money. It's like saying, I want to earn this much extra money for taking this investment risk. Present value and market price. To figure out how much a security is worth today, investors use the present value concept. It helps them calculate how much the future cash flows are worth in today's money, considering the required return as the profit percentage. Simple example. Let's say there's a company called Toyco, and they issued a bond promising to pay you $50 in 2 years. You want to buy this bond, and you expect to earn a 6% return on your money required return. Step-by-step solution using Texas Instruments BA plus financial calculator. Step 1. Enter the values in the calculator. N equals 2 number of years I/I equals 6 interest rate or required return FE equals $50 future cash flow. Step 2. Calculate the present value PV. Press the PV button to get the present value, which is the price you should be willing to pay for the bond today. Using the Texas Instruments BA plus financial calculator, N equals 2 I/I equals 6 FE equals $50, PV $472 rounded to 2 decimal places, so the price you should be willing to pay for this bond today is approximately $47. This ensures that you will earn a 6% return on your investment, considering the future cash flow of $50 from the bond. In summary, market prices of securities depend on how much investors think they will earn from the security's cash flows and how much risk they are willing to take. The present value concept helps investors find a fair price for the security based on their required return, ensuring they get a good deal for their money. Bond valuation. Imagine you're lending some money to your friend for a fixed period, and your friend promises to pay you back the money with some extra money interest after a certain time. Bonds work in a similar way. A bond is like a special type of loan that you give to a company or the government. When you buy a bond, you're actually lending them money, and they promise to pay you back the money called the face value or denomination after a certain period, along with some extra money called interest or coupon rate. Face value denomination. The face value of a bond is like the amount of money your friend promises to give you back when the time is up. Let's say you lend $100 to your friend, and they promise to pay you back the full $100 after 1 year. That $100 is the face value or denomination of the bond. Coupon rate interest rate. Now let's talk about the extra money your friend gives you as a thank you for lending them the money. It's like a little reward for helping them out. In the bond world, this extra money is called the coupon rate or interest rate. It's a percentage of the face value that the company or government promises to pay you each year. So if the coupon rate is 5% and the face value is $100, they will give you $5 every year as interest. Example, let's say you buy a bond with a face value of $1,000 and a coupon rate of 4%. It means you're lending $1,000 to the issuer company or government. Every year, they will pay you $40, 4% of $1,000 as interest. After a certain period, usually several years, they will also give you back the $1,000 you lent them in the beginning. So, a bond is like a way to invest your money and earn interest while knowing that you'll get your initial investment back after a certain time. It's a way for companies and governments to borrow money, and for you to make some extra money while helping them out. Understanding the legal provisions of a bond, exploring the indenture, face value, coupon rate, and more legal provisions of a bond. Imagine you lend your friend some money, and you both agree on some important rules. Bonds work in a similar way. A bond is like a special agreement between you, the investor, and a company or the government. Let's look at the important rules or legal provisions of a bond. Indenture. The indenture is like a rule book or contract that explains all the important details of the bond. It includes things like how much money the company owes you, the face value, how much interest they'll pay you, coupon rate x face value, and when they will give you back your money, maturity date. Face value. The face value is like the total amount of money the company owes you. It's the big number written on the bond, and it's like a promise that you will get that amount back when the bond matures. Coupon rate. The coupon rate is like the interest rate the company uses to calculate how much money they'll pay you every year as interest. To find the annual interest payment, they multiply the coupon rate by the face value. Interest payment dates. Just like how you might agree with your friend on specific days to get your allowance, the company and you agree on specific days for them to pay you the interest. Usually this happens twice a year, and it's like a nice bonus for lending them your money. Maturity. The maturity date is like a special day when the bond becomes due, and the company must give you back the face value. It's like the end date of the agreement. Once the bond reaches maturity, you get your money back, and the bond is finished. Importance of legal provisions. All these rules are very important and fixed legal obligations. Just like you expect your friend to follow the rules when they owe you money, the company must also follow these rules. It's like a promise they made to you, and if they don't follow the rules, it could lead to financial problems like bankruptcy. So bonds are like special agreements where you lend your money to a company or government, and they promise to follow all the rules in the indenture. In return, you get interest payments, and when the bond matures, you get your money back. It's a way for you to invest your money and for them to borrow money, following all the important rules. Bond cash flows to investor. Imagine you have a special piggy bank where you put your money. Buying a bond is like putting your money in a different kind of piggy bank, where you lend your money to a company or the government. In return, they promise to give you some money back over time. Let's look at how it works step by step. Buys bond outflow. When you buy a bond, it's like putting your money into the bond piggy bank. You're giving your money to the company or government. First coupon payment period 1, inflow. As a thank you for lending them your money, the company or government gives you some extra money back, like a little gift. This is called the coupon payment. It happens after the first period, which could be after 1 year. Second coupon payment period 2, inflow. After some time, they give you another coupon payment as a reward for keeping your money with them. Receives interest. Third coupon payment period 3, inflow. The company or government continues to give you coupon payments as promised. You keep receiving these rewards for being patient and keeping your money in their piggy bank. Second last coupon payment. Last coupon payment, bond redeemed. The company or government keeps giving you coupon payments until the bond reaches its maturity date. It's like the end date of the agreement. At that time, they give you the last coupon payment and also give you back the face value of the bond, which is like the total amount of money you put in the piggy bank. Yield interest rate. The yield is like a special number that tells you how much money you made per year from your investment, considering all the coupon payments and the face value you received. It's like figuring out your profit per year for the time you kept your money in the bond piggy bank. Finding the yield. To find the yield interest rate that makes the total money you received from the bond equal to the money you put in, you use a special formula. It's like a puzzle to solve. The yield helps you know how good the bond piggy bank was in making you money. So buying a bond is like lending your money and getting rewards coupon payments for being patient. The yield helps you know how much profit you made from your investment, and it's like solving a fun puzzle. Yield to maturity (ITM) is like a special number that tells you how much money you will make from a bond investment. It's a way to see how good your investment is over time. Think of it as a magic number that helps you understand your profit from a special kind of plant called a bond. Imagine you have a magic plant that grows money. When you plant your money seed in the ground, it starts to grow and gives you more money over time. Yield to maturity is a bit like that magic plant, but instead of growing money, it helps you figure out how much profit you make from a bond. Yield equals investors' percent profit per period. Let's say you buy a bond, and it promises to pay you some money every year as a thank you for lending them your money. Yield to maturity is like a special number that tells you how much profit you get each year for keeping your money in the bond. It's like knowing how good your magic plant is at growing money. Simple example. Let's look at a simple example to understand yield to maturity with a magical bond. Suppose you buy a magical bond for $1,000 and it promises to give you $50 every year as a thank you. After 10 years, the magical bond also promises to give you back the full $1,000 you originally lent them, at par price. Yield equals coupon rate. When the magical bond's price is $1,000 same as the face value, it's called at par price. In this case, the yield to maturity is the same as the coupon rate. So if a magical bond's coupon rate is 5%, the yield to maturity will also be 5%. So yield to maturity is like a magical number that helps you know how much profit you will make from your bond investment. Just like the magic plant growing money, YTM helps you see how your money grows over time with the bond. Yield to maturity and premium. Imagine you have a special piggy bank where you save your money. Buying a bond is like putting your money in a different kind of piggy bank. When you buy a bond, you're lending money to a company or the government, and they promise to give you back the money later with some extra money as a thank you interest. Sometimes when you buy a bond, you might have to pay a little bit more money than the face value of the bond. This extra amount is called a premium. Simple example. Let's say you buy a magical bond with a face value of $1,000 and it promises to give you $50 every year as interest. The bond will mature in 10 years, and at that time, they will also give you back the full $1,000. Now, let's see what happens if you buy the bond at a premium. Suppose you buy the magical bond for $1,100 instead of the face value of $1,000. This extra $100 that you paid is called a premium. Step-by-step solution using Texas Instruments BA plus financial calculator. Step 1. Enter the values in the calculator. N equals 10 number of years I/I equals. This is what we want to find. The yield to maturity PP equals $1,100 negative because you spent more money on the bond PMT equals $50 annual coupon payment FE equals $1,000 face value received at the end. Step 2. Calculate the yield to maturity ITM. Press the I/I button to find the yield to maturity using the Texas Instruments BA plus financial calculator. N equals 10 PV equals $1,100 PMT equals $50 FE equals $1,000. ITM 78% rounded to 2 decimal places, so the yield to maturity of this magical bond is approximately 78%. It means you will make a 78% profit each year for keeping your money in this bond, even though you paid a premium of $100 when buying it. In summary, a premium in yield to maturity means that you paid more money than the face value of the bond when buying it. Even with the premium, you still make a profit over time with the interest payments from the bond. It's like buying a special bond with a little extra magic for your investment.